Hey traders, happy Sunday everybody. Hope everyone's doing well. Welcome to the weekly notes live show. Great to see everyone. Gotta shut myself off on my own YouTube, wherever the heck that is. Find it, I guess. Where are you, Rog? All right, anyway, great to see everybody. Welcome to the show. So every Sunday, 6 p.m., after the notes, so I have the weekly notes, the report that I put out, where my focus is, what I'm looking at specifically, what are notable events that we're reacting to from the prior week, and what are those hot zones that we have to be preparing for this coming week. And then what are those symbols and what are those setups and trends more so that we need to keep an eye on. That link goes out to members in the options futures and of course my sector secrets mastery room. And then we have our show. So great to see everybody. And I think we're good on volume and everything else. So as always, this show is about your questions. I'm going to talk about some of the specifics that are in play for our week. And golly, if you just look at what's happening, and I'm taking a look at the economic calendar here, it is just stacked. It is absolutely stacked to be able to focus on anything other than really three things. One, we have FOMC events that are happening throughout the week. I don't think we have a reprieve at all. Let me bring up the notes here. So I don't think we have a reprieve at all. Where are my hot zones? Holy cow. There we go. So absolutely just one thing after the other when it comes to the hot zones. FOMC. In the mix of all that, we have two pretty important events, Wednesday and Thursday. You'll take a look on Wednesday. We've got the OPEC meetings and CPI at 8:30 Eastern. And then Thursday, we've got PPI. And those are important for us for mainly the reason that these are macroeconomic pillars that we are going to be focused on in terms of, hey, we look at what the Federal Reserve is going to be looking at. We focus on the needle movers for them, and that gives us an idea of what they're going to be communicating to us based on what they see in inflation, what they see in growth, what they see in jobs. Jobs is the big number. Really interestingly, what we have in terms of the post-reaction of non-farm payroll is exactly what we would expect in an environment where better than expected, stronger employment paves the way for the Federal Reserve to continue on with the path that they have suggested is already in play, which is hikes, and more hikes. And we have the first half-point hike this in May. We're likely to see another half-point hike in June. And, probably one of the silliest rallies that I've seen in recent memory, which was the the rally that ensued when Jerome Powell, as I like to call him, said that, well, we're probably not going to hike 0.75 of a point, 75 basis points in a single meeting. And the market took off. Insane. And gosh, the market took that back and then some pretty quickly, because it's not a promise that the Federal Reserve, the chairman, can make. And it's not one, even if he did, that he likely could keep, because what the Federal Reserve is going to have to do is going to be based upon the data that we get and inflation. So another really interesting question that I get, which is it's really on point. A lot of traders ask, Rog, why aren't we seeing financials rallying? How come financials are not participating with this tightening cycle that we're seeing? And the reason for it is twofold. One, where rates are right now are simply not meaningful to financials. They're not high enough. They're not high enough in terms of where we are in the rates. And therefore, whether or not that's true, I find that generally financials need to be, will move higher when rates are somewhere north of 2.5%, 3%, 2.75%, definitely more 3%. So that's one thing. But here's the thing. if there's a narrative that we have, and keep this in mind for any market, not just financials, if there's a narrative that we have and the markets are not, meaning whatever symbol you're looking at, could be the indices, could be a specific sector, a specific stock, commodity, currency, whatever it is, if that particular market, that particular symbol is not moving with whatever that narrative suggests it should be, excuse me again, I don't know, my voice had 2 days of rest and clearly is not ready for microphone time Sunday evening, but we'll get through. If we notice that there's no sync between narrative and price action, there's a different narrative. Price is never wrong. The markets are never, quote unquote, wrong. We just have near and short-term narratives that discount into the market, that are reacted to. And that's it, right? So what are we looking for? Well, what's really interesting is traders who are looking at financials might look ahead and say, our rate's going to be north of 3%. And there's a really good chance by Q2 of 2023 that they will be. We're likely going to get to 3%, maybe through it. But clearly financials, A, don't care at the moment, and B, maybe doubt that we could get there. All right. So that's a really common question that I have been getting. So I thought we'd address that right here on the onset of our show, and kick it off with the first question from Mark, who asked, on the third day completion of a higher low pattern. Oh, minor low pattern. Does the volume matter? Volume always matters. Volume is always helpful, Mark. So if you have that pattern that I teach you all completing, and as we're taking that key level out, in the case of a minor low pattern, if there's a volume ledge accompanying that level, of course, right? There's never a time where I'm going to say, volume doesn't matter, or that's not helpful. It's always helpful. That's always helpful. So if the next day falls below the prior day low, so meaning if we fall below the day 3, is that a sell signal? No, it is not. All right. No, it would not be, because remember, it's the lowest low that would be the validity for the pattern, Mark. So no to that. If we fall below day 3, the minor low pattern, 1, 2, 3 days, if we fall below that last candle, no, it would be the lowest low of a minor low, highest high of a minor high. All right. Wow. 1, 2, 3. Raghee, it's a pain in the butt to find your work. I send it out as an alert. Wow. I don't know how much easier I can make it. So if you're a member of the futures room, options room, or the mastery, it's sent out as an alert. All right. ITB lost its trend. Yeah. And absolutely. Great observation. This was many of the short squeeze scenarios, ITB, XHB. We saw some very strong surges to the upside where the home construction, home builders, the validity of the wave, the steadiness of the red grab candles absolutely was hit. Now, remember, when we break a downtrend, that does not turn a broken downtrend into an uptrend upon seeing the first, and in this case only, green grab candle. So with that being said, this is really more choppy market with directional bias that is bearish. And we've got to think a little bit more about slightly more conservative levels for our shorts. But to your point, and I love where your head's at. So now you're thinking, all right, where is the relative performance, right? If we know the overall tide is a little messy, right? We've lost that gorgeous downtrend. Do we have the ability to find relative outperformers within it? You know, enter lows, enter DHI, to your point. Absolutely. Absolutely. All right. All right. Next up, Gypsy Jones. Good to see you too. Every Sunday, my friend. Great. Thanks for being here. G asks, how would CPI affect US dollar and gold? So any event, doesn't matter if it's CPI, this is anything, G. Any event that, number one, we believe the Federal Reserve is going to be watching, right? So there's some sort of significance of macroeconomic pillar. So if there's any event that the Federal Reserve is watching, we need to be watching it too. If it's going to move growth, if it's going to be a needle mover for growth, inflation, jobs, of course, we've got to watch it. So the second part of that is so the reason the dollar moves, and there's sort of this interesting assumption out there, which is that gold and the US dollar move together. And that's categorically, absolutely incorrect. Now, I know that's not your question, Gypsy, but I thought I'd sort of answer this tangent. There's this kind of conversation where gold and dollar move opposite. No, gang, pull up the chart of gold, pull up the chart of dollar, and something's moving opposite. They should literally have mirror image trends. One of the easiest litmus tests for occasionally when the dollar and gold sync up, not to each other, but to a common narrative, which I'll discuss in a moment, gold and the euro should look similar because the euro is the absolute opposite of what the dollar is doing. So if you, for example, were to pull up UUP, nice uptrend, double green, FXE, that's what an inverse relationship looks like. Now, take a look at GLD. Doesn't look like either. So we've gotten that nonsense out of the way. But to your question, G, how would CPI affect the dollar? So let's not, and I know that, again, that's not your question, but anyone who's thinking that they're together, right? So if the CPI comes out and inflation is hotter than expected, dollar's going to go up. Why? Because the Federal Reserve has to then tame higher inflation. And therefore, their tool for that is what? Reducing asset purchases, increasing rates, maybe even more aggressively than the track we think they're on. So it should be bullish to the US dollar. As far as gold goes, okay, it's a little bit more, it's a couple more moving parts. Gold moves inverse to real yields, or what are also known as real interest rates. And so when we are talking about gold and yields, what we're talking about is this line here, which is inflation. This line here, which is the nominal interest rate of a bond. And then that blue line is real interest rates. And it's that blue line you want to keep an eye on for this narrative, for this explainer on gold. And by the way, this week, over at countdowntrader.com, anyone who's been wondering about the relationship between bonds and gold and dollar and how they sort of look like they're keying off each other, take a look, because we have a great 1 or 2 part series within the countdowntrader.com website where I talk about how this works. Notice how the blue line is sort of trickling higher. Well, gold's going to do the opposite of that blue line. So if we see in the nominal yield of a bond, the interest rate, move real yields or real interest rate, it's going to be reacting, gold specifically, opposite of that. And that's how you measure what's going on with gold and what we can expect. All right, so can we expect volatility this week? Gypsy, look, the only thing I expect, Gypsy, to happen is the markets are going to open, right? That's all I expect. The markets are going to open, and I expect also that I'm going to drink a lot of coffee. I am drinking coffee today, this evening. So the thing to remember about expecting anything is, well, how do we measure it? And so to your question specifically, Gypsy, let me grab my drawing tools here. We are, to your point, cool question, where are we in terms of the upper end and the lower end of the VX futures contract? I don't look at VIX. I don't look really anything else other than VX futures. So where are we in terms of that range? We're still flirting with the upper end. So yeah, there's a pretty good chance that we still might see some elevated volatility, but keep this in mind. The volatility is highest, the increase in volatility is as we're moving from one end, the low end, to the high end, right? It's that movement towards that level, because once we get to the high end, well, then the expectation is we're likely to start sinking back somewhere down into the range. So the most volatile part of this is just kind of somewhere in the middle, right? Crossing from one end to the other. So I would actually not expect a ton of it, but we're still up in that more volatile read on the VIX futures. So Gypsy, great question. I don't want to expect, always want to react, but let's measure where we are and get a better idea of what we could see in terms of sentiment, right? Are we going to be sinking from that level? That would be my expectation. But I'm not going to hang my hat on that trade. I'm not even really that concerned about where the VIX is when I put on specific trades. I know for some folks that's heresy, but I want to know where it is. But it's not going to, it might change my position size, the VIX reading. It also might change how aggressive within the zone that I want to be. So it'll be more of a nuanced tweak rather than I will or won't trade. So that's something that we're, always aware of what kind of, and by the way, same thing would happen with hot zones on the economic calendar. All right. What is the near-term narrative for UUP? Mr. Walker, I just want to keep buying dips. It's really nothing any more different than that. 13 exponential is fine. 21 exponential would be better. We want to buy the dip, Mr. Walker. Yeah. And by the way, don't remember that FXE and FXB, which is not that liquid, and even FXJ FXY are all in downtrends. And that's one of the reasons UUP is looking so good, because UUP is weighted with euro, with pound, with yen. And when those three currencies are weaker against the US dollar, and I'll show you how you can measure this so easily. I know not everyone's sort of, up to speed on currencies, but it's so easy to measure this. Head on over to finbiz.com, FINBIZ. Click on Forex, click on performance, and you want to look at the last month. Maybe look at the last quarter. And the contrast you're looking for is, you want to see dollar up here in the top one or two slots, right? Here's euro. So 1 month. Here's yen. Here's pound. That's okay. The reason the dollar is doing as well as it is, though, is look at the quarter look back, the 3-month relative performance, and Yahtzee. There it is. There's your three musketeers, right? There are your three musketeers. Far weaker, opposite end of the spectrum from the very strong US dollar. And that is what we are focused on. That contrast then validates focusing on DX and UUP. Up until this happens, you want to focus on the dollar and you want to get very specific to one of these currencies, because UUP trading is actually trading US dollar against three currencies, and those are the three. And there is a Forex currency trading lesson for you. Hope that helps. There's your answer, Mr. Walker. Buy the dip, but why? And this is your why. Thanks for the question. Next up, Citigroup, thoughts on possible 1, 2, 3. Let's see what we have here. I don't know that I want to play a 1, 2, 3. You talking about a reversal? No, I don't know that I want to be bullish Citi or anything in XLF. And I mean, look at XLF itself. It's in a downtrend. I don't love the idea of it, and I can't. The pattern. And by the way, for those of you that are unfamiliar with the 1, 2, 3, check over at countdowntrader.com. And one of the things that you'll notice with the explainer is we need that neutral market environment. We don't have it. So the answer on that one, my friend, an awesome question, but the answer is a big cup of nope. All right. So thank you for the question. I love that you're looking for the pattern, but remember, structure dictates everything. We want to make sure that we're focused on the structure, and then the structure validates whether or not we can focus on some sort of reversal pattern. In this case, the down 1, 2, 3. All right. Hey there, Kim. What are the possible short the rip? What are the possible short the rip for the NAS? Triggers, 21 and the wave. That's what I'm focused on right now. 21 propulsion and the wave. Yeah. Okay. So that's really it. Not too, but here's where it gets interesting. What about individual stocks? What about sectors like XL, C, Y, K, individual stocks within them? So Kim, you might find when you look at tech and the NAS, and you spread out to XLC, K, Y, SMH, CLOU, you've got a lot of fish in that pond that you can be casting for. So I like the narrative a lot. However, let's not limit to NAS. We can get a little bit more granular, right? But awesome question. That's really it. Mark, I find it pretty interesting, despite the telegraphing for a month or more and more that the rise would be 0.5%, that TLT and bonds still dropped after the rate hike. Mark, to your point, uh, the Federal Reserve has been pretty obvious about the coming tightening, right? You're absolutely right. Since Q3, Q4 of last year. So should this surprise anybody? No. But the way in which we want to continue to measure what the market saw, that FedWatch tool at CME.com, where you can look at not just what happened for this meeting, but then sort of the reverberations that go through the coming meetings and how they're realigning, how maybe quarter point hikes are moving to half, and then half point hikes are fully baked in, and even 3/4 point hikes start becoming a potential reality. That's where the game is being played, and also how much the Federal Reserve has by way of credibility. One of the things that we saw is the equity markets pulled a whole liar, pants on fire on Powell the day after he said, well, we're not going to hike 0.75 point. We're very unlikely to. Fairness to him, he didn't take it completely off the table, but he sort of insinuated that it's very unlikely. And Wednesday, the Momo traders loved it. Thursday, we woke up and said, he can't make that promise, because we don't really know what the data is going to continue to do, and they're always having to adjust, hence the liar, pants on fire sell-off. So I'm with you, my friend. But let's also remember that it's kind of physics 101. What's that saying? A body in motion tends to stay in motion. That's probably pretty spot on. The fact that we're already in a downtrend and the path of least resistance is lower, and there's clearly no reason to rally, right? There's no surprise here, and rates are going to continue to move higher, which means the bond futures and the TLT and the IEF ETFs that are the ETF alternative to those futures contracts, they should just keep dropping. So I'm never going to think that I can predict ahead of time what a market's going to do. And I try not to be surprised by what it does do unless it's an abrupt break of the trend. I will tell you, ITB, XHB, those are pretty surprising moves that that those two sectors were rallied that strongly on an absolutely nonsensical late day rally on Wednesday, right? We're not going to get a 0.75 point rate hike. So break the downtrend in home construction and home builders. That move clearly was taken back very quickly. But this is the other reason we treat these FOMC days as caution days, and that we want to be aware that momentum begets more momentum, and we want to respect the fact that, what's normal and price levels and secret squiggles, that stuff goes out the window, because when we're in that piranha feeding frenzy, like we were on Wednesday, we don't want to add logic. We don't even fool ourselves into adding logic to what's happening, because there's an abundance of illogic and abundance of just opportunistic trading in terms of, hey, we have a Momo environment, so when in Rome, right? So I agree with you, but this is where we never can hang our hats on what the market should do. We can only hang our hat on what the market does, right? All right, so ultimately, though, we're going to keep moving lower. Clearly, as you can kind of see that. Alan, I made a mistake in the rips on ITB and XHB on Wednesday afternoon. I read my option chain wrong, and they're illiquid positions. They're so profitable at day's end. Hold them or fold them. Alan, follow the trading plan. Reduce the size if you're concerned. Know your target. In XHB, we've gone down and tagged that lower Darvis. Scale out, move to break even, right? That's what I teach you all. Scale out, move to break even. On ITB, it might be a little bit trickier, but scale out, move to stop to break even. So, anytime you have illiquidity, you have to give yourself a little bit of extra time, my friend, to manage that, because it might take a little bit longer to fill. Open interest might be low. That usually means volume could be low as well. So give yourself a little bit extra time to fill that trade. ITB is not terrible. XHB is not terrible, but you might be in an illiquid position. I got it. Review, re-examine where that open interest is. It may not be that bad, right? If you bought puts and the markets are heading lower, funny how all of a sudden our very quiet party has more people coming to it. So check that out tomorrow at the bell when the bell opens, but bell rings. But remember, there's no harm in scaling out of half the position and moving the stop to break even. That's what I've been teaching you all, and that's exactly what I would recommend, my friend. All right, DBA, am I still bullish, or would I prefer other areas of the market? I'm going to answer the second part of that first, and I prefer other areas of the market because on April 21 to 25, we had absolutely a heartbreaking, darn near gut-wrenching, and for me, I took 4 losses after a string of weeks of really productive, profitable trades. That commodity, miners, metals, commodities just rolled over. And I mean, in a way that we haven't seen them roll over in a while. It happens. It was the one last trend trade, and it was a really volatile one at that. So I'm not going to go back into those. I think the only one that's hanging on by a thread is Archer Daniel Midland, right? So absolutely, you got it. We're going to start refocusing where there's better clarity. Now, amongst all those commodities trades, those weren't the only things we had open. We had Wells Fargo, we had Citi, right? So we had other trades on at the same time that were not just, hey, let's go all in on commodities and miners and so forth. Not at all. But clearly, those trends were broken. These other trends that we have exposure to are still good, still intact. Double red, double green, say in Natty Gas, different names at FCG and XOP. So some things survived, some things did not. And that's what the weekends for me are all about, right? What survived, what didn't. All right. And certain stocks, like you mentioned, Bristol Myers, did survive. Yeah. There are certain names within XLV that absolutely did survive that pullback. So, when you look at the XLV, you'll find there aren't that many uptrends there. So be careful. But yes, you'll notice that you're absolutely right. When I talk about double greens, I'm talking about the JT multi-trend. I'm talking about our trade flags, and focus on the double greens and double reds. That list, our watch list, should very naturally be shrinking. And that's not always great. When you notice that your daily time frame, double green and double red watch lists are really contracting, cutting in half or worse, that's in many ways a cue to start shortening your time frame. And I naturally start to shorten my time frame into summer anyway, because and I've been really sort of making sure everyone understands, because it's going to be repeated so often, it's mind numbing. But sell in May and go away was never a short signal. In fact, it's not a short signal at all. A lot of traders who are typically inexperienced hear that phrase and take it quite literally. It was never, ever, and it's actually historically not accurate. Sell in May and go away, frankly, doesn't work. It depends on what's happening with the underlying markets and what's happening with the central banks. But if you were to go back year after year after year, 20 years, 30 years, you'll see very rarely between May and so Memorial Day and say Labor Day, are you actually going to have a sell in May and go away factor that's bearish. It's very rare. Doesn't happen that often. Sell in May and go away. And the reason day trading makes so much sense in the summer is that the old saying was money goes to the Hamptons. It's illiquid over summer. There's less interest over summer. In the 80s and the 90s and even into the very early 2000s, it was still somewhat common. But when I look at 30 years into my career, where I spent a good number of that time between Memorial Day and Labor Day, really taking a lot of time off trading because of the fact that it was typically illiquid. The B teams, as they were said, would be at the trading desk and the money's in the Hamptons. That's what that means. Illiquidity, not bearishness. Okay. I want everyone here to be, understanding what that meant. It was the illiquidity. So when you start to notice that the, to the day trading side of things, when we have very few double reds and double greens, which is part of Greg's question, what are those trends we're looking for? Then when we're getting more yellow trends, it's time to start thinking about day trading, which is why every summer for the last, 2 or 3 years, we do a summertime day trading class. And my next one's coming up on June 25. So is the multi-trend part of the mastery? It is, Greg. It is. We included 2 members who joined the mastery. We sure do. We give you all a pre-built layout with all the tools that I include to Mastery members, the Sector Secrets Mastery. And then we also give you all access to those of you that are on TradingView. We push those indicators out to you. So it is. All right. So gang, just like that, holy cow, the show the show goes by so fast. Thank you for all the great questions. I really appreciate it. As always, gang, thank you so much. If you're a member of the Futures Room, Options Room, or Sector Secrets Mastery, the workflowy link is in the alert section. I've sent that out, so it should pop up on your phone. You'll see it in the rooms. And I'll see you all tomorrow for our daily Monday through Friday charts and coffee show, 9 a.m. as always. And I will see you all soon. Thank you so much for joining us for the weekly show. Appreciate the time. Appreciate the questions. Go enjoy some dinner. Enjoy the rest of your weekend. And I'll see you tomorrow. Be good to each other, gang.